Hey friends, PK Patel here from Midwest Corporate Credit, where funding your business is our business. So lately, we've been getting bombarded with offers from our credit card companies to take out personal loans against your available limit. Should you or shouldn't you do this? Is it a good deal? Let's do a deep dive and discuss the pros and cons so you could make a better decision. Alright guys, so I'm going to use Citi Flex Loan as an example. I have a Citi card that constantly bombards me with this offer every time I log in. You may have a Chase or Bank of America card, or any of the other major banks are doing the same thing. I've seen similar offers, so let's just go ahead and use this one. Alright, so as you can see, on the left side here, I can have up to a $20,000 loan amount, and I could choose based on how long I want the loan and how much I want the payment to be. It lets you play around with this. As you can see, the monthly payment's $298 if I want $15,400 for 60 months, and you could see what happens as I condense the amortization table down to a shorter period. My monthly payments are going to go up. So most major banks are going to have a platform like this that lets you pick. Look at this APR, it's only 6%. So we're going to discuss that a little bit later in the pros and cons section, but this is what I'm talking about. So this is off of my Citi Double Cash card, and this is directly off a credit card basically. So what they're promising is you'll be able to get a loan directly off the available credit limit that you have, and there's no new inquiries. They're simply going to show it as a credit card balance. So let's just say I have a $50,000 credit limit. They're going to advance $20,000 of it, give it to me as a loan for 5.99, or let's just say 6%. So that's what it looks like. Okay, so you've seen the offer, you like it, now you're ready to pull the trigger on this. Not so fast. Let's discuss some of the pros and cons. Okay, so what are the pros? Obviously low APR, 5.99%. This is heck of a lot better than paying retail credit card interest, which could range anywhere from 11 to 20%. So if you have any of those types of balances on any other credit cards, this would be a wise idea to consolidate and lower your payments and your interest a little bit. Next is fixed payments. You know exactly what your payment's going to be, and you know exactly when it's due. You even chose the amortization that you want. I believe it's 12 months to 60 months, which is 1 to 5 years, if I remember correctly. And it's completely up to you. They had a selector where you could choose that. So very flexible, it's great. There's no credit inquiry, right? So you're able to get this loan without incurring a new credit inquiry, and they're not going to look at your credit, which is always a positive. And this is the same as cash. Who doesn't like cash? They're willing to put this in your bank account, and you could do whatever you want with it basically. If you're an investor or a business owner, that's the language of love for you, cash. All right. Now, there is a big drawback that I want you guys to be aware of. Taking this is going to obliterate your FICO score. So basically, what the bank is going to do is they're going to, let's say I have a $50,000 limit on that Citi card. If I choose to take a $20,000 loan from it, on my credit report, it's going to show up as I'm using $20,000 out of the $50,000. And if that percentage gets too high, you're going to be punished quite a bit by the credit scoring models and the credit bureaus. So be cognizant of that, especially if you're going to make any large purchases in the next 12 months. I'll give you an example. Let's say I take this loan out for $20,000 and I consolidate some debt, maybe save a little bit of interest, but I have to buy a house within the next 12 months, and that lower credit score, now my credit score is next tier down. That lower credit score causes my mortgage to be priced maybe a quarter or a half a point higher. For a 30-year mortgage, I could be losing heck of a lot more money by taking this than just foregoing it. We show business owners how to do this on the business end of it so that these types of balances don't even report to your personal credit. If you're interested in something like that, go to our website, applymidwest.com, and we'll show you how to do that. But let's keep moving. The one X factor right here that I want you guys to be aware of is you need to know exactly how the payments are going to be allocated in the future. For example, if I take $20,000 loan from this credit card and then the following month I make a $1,000 purchase, the next payment that goes in, how is the bank going to allocate that? Is it going to go towards paying down the loan, or is it going to go towards paying down my purchase? Keep in mind the purchase is going to be at like 17-18% interest. So if the payments are being allocated to the loan first, I could be in a trap where high interest debt is accruing behind the loan, and I have to go all the way through the loan and pay it down before I hit that high interest debt. So be cognizant of that. The best way to find out is call your credit card company, the number on the back of the card, and ask them exactly how it works. It's different in every state, it's different with every bank, and it's different even down to what credit card you have. I don't know all the ins and outs of that. It's going to depend on what you have and where you live. So just make sure you know how that works. If for some reason the bank is going to allocate money towards a loan pay down first, and you're going to end up with a bunch of high interest credit card debt just sitting there until you completely pay off the loan. Personally, I don't think it's worth it taking the loan, but the way I would play it and the way I would beat the bank at their own game is take out this $20,000 loan when I have a zero balance on my credit card, and then never use it for any more purchases until that loan is completely paid off. So that way I get the best of both worlds. I get my 5.99% interest, and every payment that I make is going to go towards a loan pay down, and I would not even use it accidentally. I would make sure it's like tucked away where I can't find the card anymore, and that way you get to take advantage of this loan without getting stuck with high interest debt accruing on the back end. All right, my friend, I hope that helps you make a more educated decision. If you like this video, subscribe to our channel or opt into our email list. For Midwest Corporate Credit, I'm PK Patel. I'll see you next time.